Hi, good afternoon. Welcome to the Option Ranger buying Dow Jones calls for bullish direction and rising volatility. Today is Tuesday, April 1st, 2014. I'm Chris Chelius, part of the Option Ranger Development Group. Now, an important disclosure. Please be aware that trading stocks, stock options, futures, and options on futures involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read and understand all disclosures before investing. All of the examples discussed are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, type them in the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He is the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends in All Markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, once again, welcome to the Option Ranger buying Dow Jones calls for bullish direction with rising volatility. Mr. Mueller?
Thank you, Chris, for the introduction, and I look forward to our program today on buying calls, and we will be focusing specifically on the Dow Jones Industrial Average by way of illustration. First, let's have a look at a weekly chart on the Dow Jones over a longer term. And although this is not a recommendation one way or the other, we're trying to provide a predicate for where and how a person who chooses to be bullish for a variety of reasons may want to enter the market. As you see here, we have a weekly chart on the Dow Jones market. Even putting aside the indicators, you can see how somebody might say, well, I think the market's going to go up. But the big question is how to approach being long the market, especially if fearful of the possibility of a large correction or a drop. So for a variety of reasons, we're going to go ahead and pull up the scenarios and come back to this chart so that we can see in better perspective, at least at this moment, how exactly an in, at, or out of the money option would look relative to the prices in the market. This would enable us also to visually get a grasp on the magnitude of move that would be necessary for the purchase of a call in this particular market to become profitable. And we'll look at different classes of options and different classes of risk in terms of those options. Now let's begin by having a look at the Dow Jones market on our markets page. Remember, you can go to our markets page and select by market. So somebody who is contemplating getting into this market would want to see the contract specifications. As you can see, we have more recent news on a variety of markets. On the left, you have the Dow Jones chart. This is a 5-minute chart. That time frame can be adjusted. And on the right-hand side, developed by me along with the Dow Jones editorial team, is a series of market factors to monitor when trading the Dow Jones market. So before putting on a trade and coming out with an outlook, somebody might want to check some of these sources, some of which are linked to the primary source of the information and some of which are listed, and we have to do our own secondary research. This is a pretty comprehensive list. We're always open to suggestions, add items. Many of these need to be monitored not just when a trade is initiated, but throughout a process of being in a particular trade. Let's have a look now at the scenario for buying a call using our strategy gallery. And as you are well aware, there are two factors that we take into account when looking at various strategy alternatives. The first is direction, and the second is volatility expectations. In today's scenario, again, because we were looking at somebody who would have look at this chart and for some reason believe that the market is going to be bullish or go to the upside, this particular outlook would fall under the bullish category. And again, when purchasing a call, which is the demonstration we are doing today on different classes and strike prices of call options, the expectation, and this is extremely important, that's why it's one of the two key factors that are followed in making a determination about a particular position, is that this is not just a bullish outlook, but it's a bullish outlook with an expectation of rising volatility. So there's an expectation that the market will not be slow if it's perceived as being slow, but rather it's going to move up at an accelerated pace. Today's program is going to focus for somebody with this particular expectation on any market, using the Dow Jones as an example, how exactly would they go about selecting which call to purchase based on their outlook, because there are multiple option series and multiple strike prices. And as you can see here, we pull up the particulars of a long call if we want to. And we see that, as we indicated, the trade is a directional trade, a bullish trade. The belief is that the market is going to go up significantly enough to overcome the premium that was paid for the option plus the cost of the transaction, so that the trade goes into the clear and becomes profitable. The maximum profit for the purchase of a call is theoretically unlimited, because once that premium cost is overcome, the market can continue going up and up, and the increases past that point would increase as the market goes up and volatility goes up. The maximum loss is limited to the premium and the transaction costs, the total costs paid for the option. As we've indicated before, time decay is an enemy of this position, which is why it is a trade that anticipates rising volatility. The volatility and the direction have to move sufficiently to overcome the negative effects of time decay. And in today's examples, we're going to try to look at some current levels for purposes of illustration of how the selection of a strike price and a particular option can incorporate different levels of time decay or expectations as to volatility going up, and specifically how far up. Then, at a glance, we have the trade details on purchasing a call, which were reviewed and which can be reviewed by the participants both in here, by watching our buying gold demo, which is an illustration how to input a call option yourself in the software. And of course, we also have in our reference materials section, and under demo videos, we have a significant selection of basic strategies, including some additional examples and webinars on today's strategy of buying a call. Once we have this outlook in mind, and we realize that essentially while somebody has to select a strike price and decides to have an expectation here of rising volatility in order to buy the option and overcome time decay, one of the principal reasons to consider buying a call is that it is an opportunity for people to participate in a market with or without leverage, with a predetermined and limited risk. So the disadvantage of time decay and option erosion are on the opposite side of the incentive of being able to initiate a trade without having the risk of unlimited loss and margin as illustrated on the grid. Now let's go ahead to our basic calculator, and we've already input the trades to save some time. so that we can do these illustrations. They are saved under the Dow Jones Bullish Trades tab, and we are looking at June expiration options. The first option that we are going to look at is it's purchasing a 1600 call. And as you can see here, the minute we select the trade, whether we input it or we select it from a pre-existing tab, we get a fast reminder, a visual reminder of the particulars that work for this trade. We get a profit and loss graph that shows the effects of time decay, which are negative. As time passes, the time value portion of the option erodes. Therefore, we have the reminders here that this is not just a trade that looks for up direction, but needs to be accompanied with an increase in volatility. When we input the particular of the trades and select Dow Jones Industrial Average, as you can see, the contract particulars for this market come up. And if you want to review the contract specs that we visited earlier with the What to Watch section, you can always go inside the dialog box and click on the additional link that's going to take you to the contract specs section. The buy or call features are indicated as to direction, volatility, and time erosion. We've selected one option with a strike price of 1600, and the market is around 1640 and change. So we are basically looking at, in this particular case, we are looking at an option that is an in-the-money option. That means that this particular option is below the market price. Specifically, if the market is at 16,450 and this option is at 16,000, we are looking at an option that is in the money 450 ticks. Okay. Now, as we look at the strike price, we're looking at a premium of 62.7. And again, whenever you click on strike price or you click on premium, you are taken to some helpful links that will give you a further discussion of strike price and premium examples. For example, and let me just go show you right now, since we are buying a call here, you can either go quickly to our reference sheet, which will redefine buying a call, the right but not the obligation to go long the instrument from the strike price. So that's the strike price is your exercise price. And of course, we do have the ingredients of how an options price is made up. One is time value, which is the time left to expiration that is added to the premium. This is the element that is affected by time erosion, because time value disappears as time passes. And there's intrinsic value, which is the in-the-money value, the amount by which, in the case of this particular option, the market is below the market price, or you can say the instrument is above the strike price. And we actually have some examples of this that you can see. So in the case of calls, a deep in the money option, as you can see, is well below the market, has a lot of intrinsic value, and an in the money option is slightly below the market, so it has intrinsic value. An at the money option has no or little intrinsic value, and when you buy out of the money or deep out of the money options, they have no intrinsic value whatsoever. They're made up strictly of time value, and if the market doesn't move with rising volatility, that time value can erode to zero, and that's where the maximum risk comes in. So let's go back to our example now, and as you can see, if the market's at 16,450, the 16,000 is in the money. It's below the market per our grid, and we've already seen it here. We'll run more examples. And as you're going to notice here, we paid 62.7 points in premium. We factored in the costs. We put in a number of output rows, which is 40. And let's see the particulars of the trade. First, we'll look at the trade at a glance. The option that was purchased, the strike price, which is where you have the right but not the obligation to be long the instrument or to exercise into the instrument. The premium paid is 62.7. which translated into dollars and cents on the Dow Jones tick is $6,270. So this person is paying a premium of $62.70, and factoring in transaction costs at a default here, the total transaction is $6,325 to have the right to be long this market. Now bear in mind that if this position is 450 points in the money, that means that $4,500 of this position is in the money value, so the portion that can erode is the difference between 4,500 and 62.70. Well, let's look at and we'll be able to see that on the spreadsheet now. As you can see here, what we do first and foremost in the boldest way possible is list the maximum loss. In this particular transaction, the total maximum loss can be no greater than the premium and transaction costs, which are already listed at $63.25. Whenever you look at a net long premium trade or a paying premium trade, the debit on the trade and the maximum loss possible in the trade will be identical. Of course, in order to incur this maximum loss, one would have to watch the market not do what is expected and watch time erosion go down so that the option becomes worthless. Most serious thinking investors, especially when they commit a serious amount of money to a call option, are going to be mindful of the premiums and not wait for a total loss on expiration. So this is the total possible loss. I think it's rather absurd and should be avoided for one not to exit this trade significantly before they incur the maximum loss. Now let's look at the particulars again. We have the values, the units, the ticks, and let's look. As you can see, and this is why this trade is a non-margin trade. That's why the buyer of this option pays the premium in part, because if they are wrong, no matter how far down the Dow Jones goes, you can have some kind of geopolitical event or financial event, and you can look all the way down. Doesn't matter if the Dow goes to 5,000. The maximum loss on that position is predetermined and limited. On the other hand, once the costs of that trade are overcome, either in premium, which is 63.25, which you can monitor daily, or intrinsically at expiration at 1,663.25, intrinsically it is above this contract number that the position is in the clear intrinsically to make money, and also above the premium. Throughout the trade, one should be sure to monitor this premium number for current values, but if holding the position, always to be mindful intrinsically of where this market needs to go to be in the money, so to speak, on the underlying contract as well. And as you can see now, once the market on the downside, things are pretty clear and predetermined. Once one begins to overcome the break-even level, as you can see, for somebody looking for an upside move, the profits can become pretty significant. Let's go ahead and again, this is a deep in the money options. As you can see, it's more costly, but at expiration, even if the market doesn't make an extraordinarily large move because there's a smaller element that is susceptible to time erosion, one is in the clear sooner because the only portion that is eroding is the non-intrinsic, is the time value, and everything else is factoring in. So in this particular case, if the market is at let's have a look here. Let's say we're at 16,060. As you can see, the market's already beginning to make some moves. Whereas, let's look at another example. And let's look at the next example now. The next one is going to be an at-the-money option. So again, when we look at the examples of where is an at-the-money option is basically where the market is. So it'll either have no intrinsic value or very little intrinsic value and will comprise mostly of time value. So here, erosion is a factor. Even more so, there's no intrinsic value, as you can see, so that the market, when we go back to our example in this particular scenario, what is the trade-off? Well, first of all, the person, and we get all the particulars on the trade here for buying the 16,450 strike at 32.80. Okay, we have all our costs factored in. And as you can see here, all the particulars come up. Now this option, because it's not in the money, it's at the money, it's all-time value, is significantly cheaper than the deep in the money option. So as the deep in the money option, including costs, was at 63.25, the at the money options is at 33.35. So it's close to half the cost. However, which is good, the maximum risk is also smaller because, as you will recall, the most that can be lost when one purchases an option is the cost of the option, which is comprised of the premium plus transaction fees. So here, the total risk is lower, the total initial debit is lower, the premium to be overcome is lower, and as you can see here, the break-even price on futures is also factored in here at 16,483.35 versus 16,063.25. So again, there's a lower break-even, but let's see where we are. And again, when you look at the grid, you'll see that the maximum loss, no matter how far down the market goes, is limited. And then you see where this trade becomes in the clear and starts breaking out. The multiple factors for a person to consider whether they're going to buy the in the money, and it's fairly deep in the money option, or an at the money option varies a great deal depending on how much the initial outlay is that a person is willing to incur and risk. Directionally, where do they think the market's going to go? Is this number a more realistic number than the other number, according to this particular speculator? And finally, and just as importantly, does the sweet spot or target zone of this trade for the cost make sense? Again, the second person here is strictly involved or mostly involved in paying time value. The first person puts out more, but in a flat market they reserve some of that intrinsic value, whereas in a flat market, in this particular case where it's all-time value, then they would lose 100% of the option. So in this case, one might salvage, let's say, 45 points of premium if the market stays flat, because there's that in-the-money value there, as we can see, whereas in the second scenario, a flat market at 16,450, if it's not in the money, this entire premium would disappear. Finally, we have a third example, which is an out-of-the-money option. And again, I wouldn't call this a deep out-of-the-money option. Again, the farther out of the money it is, it can become far out. It's a deep out-of-the-money option. And likewise, if one buys deep in the money, it's another type of option. And we will discuss later on the various scenarios when this is considered. We also have a previous webinar in which this type of selection is discussed in a little more detail. But now we're going to go to an out-of-the-money example, which means that this option is above the market, so the market actually has to make a move to get to that price intrinsically. So it has, not only does it need to go up to catch up to the strike price, but it also needs to do so with rising volatility to overcome the time decay effects of the option. So in a sense, an out-of-the-money option, the farther more it is out of the money, the larger the move it requires, and of course if it gets far enough out of the money, it becomes a long shot. And let's have a look now at the final trade, which is the 16,900 call, which is above the market, and of the three transactions, and as you can see, this is the cheapest. We went from 62.70 in premium to 32.80 in premium to 12.30 in premium. It's an easy market to calculate because we're talking about a decimal-based market, and multiplication is by 10 or 100. So again, in this case, we have 12.3 And again, at 100 per unit movement, value of one option unit of 100, 12.3 times 100 is 1230. The transaction costs are 55, so the net outlay is 1285. And again, one of the reasons somebody would spend that premium and deal with time decay as an adversary and rely on rising volatility is in part perhaps that they just want to make sure that their risk is limited, and in this particular case, as in every case we've seen, the maximum loss that can be incurred, 1285, is identical to the net debit when the trade is initially placed. It's very important for people who do pay premium and fight against time erosion in their trades to always be mindful of current premium values, current values relative to the break-even point, and be very mindful that sometimes he who fights and runs away lives to fight another day. So again, I think it's ill-advised for people to incur that maximum loss if they have time to monitor the trade and have the opportunity to offset either at a break-even or for smaller losses, or perhaps for smaller gains if circumstances warrant. Now we see a spreadsheet where the outlay is smaller, but the futures break-even now is much higher. We're looking at a break-even of 16,912.85 and on premium 12.85. So if this market doesn't make a pretty significant move, we're talking about being at 16,450, it takes quite a move to get past that futures break-even point. So one needs to monitor the premium, see if volatility makes a favorable move, and also to look for an exit if the move with rising volatility does not occur. Again, when we look at the intrinsic values here, again, as you can see, the risk is limited. The Dow Jones can go to 5,000 or 8,000 or 1,000. It doesn't matter. That's the maximum loss, assuming no early exit. And as you can see intrinsically, the break-even is at a pretty high number. So if somebody thinks that they're going to hold this position long-term, they would need to have some reasonable expectation that one way or another, hopefully sooner rather than later, this market with rising volatility would make a significant move up and hopefully exceed this intrinsic level, or perhaps very quickly get to a lower level where the volatility and the direction are working out sufficiently to generate a profit. Again, because this person is looking for explosive rising volatility, even buying an out-of-the-money option, a fairly well out-of-the-money option, I would add. However, on a large move, this speculator would get rewarded because once the premium break-even is exceeded or the intrinsic strike price is exceeded, the position is in the clear to gain significantly. So as you can see here, in a particular scenario of somebody going to a strategy gallery and wanting to select a trade which is bullish with rising volatility, we see how important it is in making that choice to understand the different classes of options and how to select them and when to select them, to understand the different terminology and to distinguish between the components of an option, the portion of an option that is in the money and the portion of an option that is out of the money, because it is the portion that is out of the money, if the market does not move, that is going to be hit by time erosion and time decay, which are major factors in option trading. Do we have any questions?
Not at this time, Mr. Mueller.
Okay, well, thank you very much, Chris. For those of you who do want to review this information, please go to our reference material sections. You can go to demo videos. There's a discussion of volatility and option classes and multiple webinars, and as well as to just read the basic on strike examples so that you can see those relative to the market. And if this did not help you sufficiently, you can go to a previous program in which these particular factors are discussed in somewhat greater detail. When you look at this type of trade, again, it's sometimes mindful, and let me just pull it up before we finish, that one look at a longer term chart and then begin to consider the particulars of a trade when they select an option, and sometimes it's good to print out a chart or print out that spreadsheet so that one can have a look and say, well, where is the market? This is where the market is right now. And then you would say, well, just exactly where would it have to go to exceed that number, to exceed that 16,900 number. And again, you want to really get an idea of it by going up and down and seeing if that number is within your range or realistic expectations on the chart. And likewise on a drop, you want to see that if there is a substantial drop that is possible, that's a place where you might also consider a call option rather than the underlying instrument, which would lose tick for tick on a drop. If you have any questions on this particular on buying calls and how to select different classes of options in order to use the strategy according to your expectations, be sure to either contact us or contact us on the forum and let us know, and we'll be more than happy to get you the answers and additional support information. I wish you all a great week trading, and we'll be talking again soon.